All right, let's move on, look at an example of using the CAPM, and then we're going to look at alpha and at the arbitrage pricing theory, a couple of other theories that help us understand, give us a framework for looking at the market. So let's look at CAPM first. All right, an example of using CAPM. All right, you intend to buy and hold Microsoft stock for 5 years. The 5-year Treasury has a 5% yield to maturity. One of the debates about using CAPM is what is the maturity of the risk-free rate. Well, in this case, I decided, since we're going to hold Microsoft for 5 years, we'll buy the 5-year Treasury. There are some people who agree with me on that and some people who think it should always be the Treasury bill. Remember that 5-year Treasury has a lengthier maturity, 5 years versus 6 months for a Treasury bill, and so it is subject to some volatility, okay? So some people don't agree with using anything more than a 6-month Treasury bill to represent the risk-free rate. Okay, Microsoft's beta is 1.4. What this means is that for every 1% the stock market moves, Microsoft stock moves 1.4%. It's 40%, Microsoft stock is 40% more volatile than the overall market. All right, analysts expect the stock market to return 12% this year. Oh man, they must think the market's really going to do well, better than normal. What should investors demand in the way of return to own Microsoft? So what rate of return justifies owning Microsoft? Okay, and so the required rate of return, according to the CAPM, is the risk-free rate, which is 5%, plus the market premium, which is 12%, minus 5%, adjusted by the beta of 1.4. So let's plug it all in. There it is, risk-free rate. So the market premium is 12% minus 5% is 7%, adjusted by our beta of 1.4. And here's our expected rate of return of 4.8%. So what this equation is telling us is that we should not buy Microsoft unless we believe that in the next year, the price plus the dividend for owning Microsoft will give us a total return of 14.8%. If we don't believe that, then we shouldn't buy the stock. So what we have to do now, and we'll learn this in a later chapter, is come up with what we think is an intrinsic value for Microsoft. What is Microsoft? What do we think the stock is worth? Then compare that stock price, that theoretical intrinsic value that we come up with the current market price. And if we can earn, if the current market price is less than 15% less than Microsoft, if the current market price is 15% less than the theoretical market price that we came up with, the theoretical intrinsic value, in terms of capital appreciation and dividend, then we should buy it. But if we can't earn 15%, we shouldn't buy it. Okay? Now let's look at alpha. All right. So CAPM theoretically establishes the required rate of return for a stock or for a portfolio. That rate of return that justifies taking a risk. Okay? What if the actual return that we realize is different than what the CAPM predicted? Okay? This difference is called alpha. It's an unexplained difference in return. Hey, we have a guest, we have a student who's coming in to say hello. Bye-bye. All right. So alpha, let it be noted that alpha can be positive or negative. I welcome guests, so y'all need to stop by the studio. You can stop by the studio at any point in time, and I'll put you on national television. All right. So alpha can be positive or negative. Of course, we want to earn positive alpha. Yes, we want to earn that 14.8%, but wouldn't it be wonderful if we earned 24.8% or 44.8%? Okay? So alpha, the formula for alpha is your realized return minus what the return you would have earned according to CAPM. All right? Alpha is sometimes called the Jensen index because Jensen is the financial analyst who came up with this idea for alpha. So you compute what you think the required rate of return is and should be, and then you compare what you actually earn with the required rate of return. And if you earn a return in excess of your CAPM expected return, then you have really done something special. You've generated alpha. All right, let's look at some studies about alpha. So, Jonathan Burke at Stanford, Jules Van Binsbergen at Wharton, they suggest that the typical mutual fund manager is persistently skilled and that the top performing managers are especially good. Okay, but the problem is the market is so liquid, it is so efficient, it is so hyper competitive that most investors do not benefit from the skills of professional money managers. The advantage that these managers have at picking stocks is quickly competed away as money pours into superior performing funds. What happens is if managers experience a really good track record at picking stocks and building portfolios, then demand picks up and money pours into these portfolios, and it becomes increasingly difficult for these managers to sustain their performance record, their superior performance record. So what ends up happening is the managers and the companies they work for, rather than investors, reap the rewards by receiving higher fees from the larger market value of the portfolio. Remember, the way these guys get paid is you charge a fee rate times the value of the portfolio. And if money is rushing into the portfolio, the value of the portfolio increases times that fee rate, and these guys make a killing. So the investors don't do nearly as well as the investment managers. Okay? All right, that brings us to another theory about how assets get priced and valued called the arbitrage pricing theory. Okay? And it was developed after the capital asset pricing model. So the CAPM is what we call a single factor model. It only looks at one thing. It says the return for a stock is a function of beta. Beta, okay? The arbitrage pricing theory is a multi-factor model. It looks at a number of variables that might contribute to the movement of a stock price, okay? So the APT says that the risk premium for a stock is a function of how the stock responds to several macroeconomic variables, not just the market, but several things in the economy, not the market, the stock market, but the economy, okay? So here are the possible variables that people have studied, these variables that move stock and asset prices, okay? Inflation, industrial production, and the shape of the yield curve, which is the risk-free rate, okay? These things affect movements or changes in inflation. Industrial production is a proxy for the economy. How's the economy doing? And then the yield curve is a proxy for the Federal Reserve monetary policy and also for investors' views of the financial markets. So individual stocks respond in a unique fashion to particular factors. So we look for these different factors and how stocks respond to them. For example, commodity stocks may be very sensitive to changes in inflation. Okay? Typically, if inflation picks up, commodity prices pick up as well. All right? If you think inflation is going to accelerate, then you buy commodity stocks to try to keep up with inflation. Alternatively, the moves of forest product stocks like lumber companies may be closely linked to changes in housing starts. When we get into the chapter on fundamental analysis of companies and their stocks, we'll take another look at trying to link together stocks and economic variables that may drive them. When is it time to buy the stocks of companies in particular industries? When is it time to sell? All right? If you see housing starts picking up, for example, the press reports this all the time, maybe you buy the stocks of forest products companies because they sell lumber to the companies that are building the houses. So you're trying to see a cause and effect. If housing starts pick up, maybe it's time to buy the stocks of forest products companies. All right, so what conclusions do we come to? First, understand the job of a portfolio manager. which is to ascertain the risk and return profile of a client and to build a portfolio that reflects those needs. That's your job as a portfolio manager. Only take on risk when you are going to be compensated for that added risk, risk aversion. Okay? Risk has two components: company-specific risk, which can be diversified away, and systematic risk, which also can be lowered, okay, through diversification. So here we go, company-specific risk can be eliminated through diversification. Systematic risk can be reduced through international investing and also by investing in different asset classes, okay? In the investment world, risk is defined as volatility. Because of diversification, volatility can be reduced to the relationship between a specific stock and the market. How a manager structures a portfolio is a function of the client's risk and return profile, the current valuation of a stock and its earnings and its risk prospects, and the beta of the stock. These are all things that drive stock valuation, which is the correlation the stock, and also the correlation the stock has with other stocks in the portfolio, okay? And the manager's outlook for the market. All of these things combine together to impact how a portfolio manager is going to build a portfolio, okay? The individual securities in a portfolio should reflect the goals that the manager has for the clients, the goals of the client and the manager together. All right, so this slide is what we managers keep in the forefront of our minds as we are building portfolios for our clients. All right, so we're finished with Chapter 7. We'll move on to Chapter 8, which looks at the efficient market hypothesis. You think about that while we take a break. Shalom.